Hey everyone, and welcome to another episode of Wealth Strategy Secrets. Today we're joined by Rob Beardsley. Rob oversees acquisitions and capital markets for Lone Star Capital and has acquired over $300 million in multifamily assets. He has evaluated thousands of opportunities using proprietary underwriting models and published the #1 book on multifamily underwriting, The Definitive Guide to Underwriting Multifamily Acquisitions. Rob, welcome to the show, my friend.
Yeah, thanks a lot for having me.
Yeah, no, really great to have you on. And I think investors are really going to get a good appreciation for, some of the underwriting, tactics and techniques and, your experience and looking at so many deals and really being, one of the best in the business when it comes to underwriting. And I think also really from a limited partner perspective, right? I think a lot of folks, don't really understand, all the mechanics that are going on in underwriting. So I think it would be great to jump into that. But Rob, to kick things off, why don't we just tell the audience a little bit more about yourself and, your journey into, real estate and building wealth, and how did it all start for you?
Sure. I grew up in Silicon Valley in Northern California, and my parents were in residential real estate. And so they did obviously their primary business was buying and selling homes for their clients. But they on the side did some flips and some construction, but they never really were investors per se, right? It was always about making an income or, churning deals quickly and things like that, never really accumulating assets or building long-term wealth. So I didn't really open my eyes to this kind of building wealth paradigm until more so into college, when I started reading books on real estate and Rich Dad Poor Dad and all that kind of stuff that opened my eyes to, yeah, that's the journey that makes sense to me. And originally when I saw my parents run their business, I was kind of put off by real estate and wasn't particularly attracted to it because they were just running around stressed out, and it didn't really look like a lot. They were having a lot of fun. So it's funny that eventually I did circle back to real estate and ended up, meeting my business partner and starting Lone Star Capital, which, as you introduced us, is a multifamily owner operator that's focused in Texas. And so that's been obviously a fantastic journey of building a business, but also doing investing alongside the business, right? That's I would say the #1 perk of being a sponsor and being in the business that I'm in, is that I get to invest alongside my investors and kind of get all the benefits of this wonderful strategy.
Yeah, no, that's awesome. And I mean, tell us from your perspective then. I mean, we have a lot of investors who do invest in, single family rentals or vacation rentals, things like that. But, having done both types of investments with those and also in doing more passive investments, what would you say the difference really is, from your perspective?
The difference is one is active and one is passive. As much as people want to believe that their rental is turnkey, there's always something going on, and there's always some responsibilities that you may have. So it doesn't necessarily have to be a nightmare, but it's just not truly passive. You're essentially running a side business, which is great, and it's profitable and it can do well, but you may be taking on a bigger headache or more risk than you really fully understand, and you won't see it. That risk won't necessarily come to the surface until something bad happens, like unexpected capex, or again, if it's a single family rental, your tenant leaves you, and then now you have 1 or 2 or 3 months of vacancy, which has a dramatic impact to your annual P&L. Whereas in multifamily, you have a 200 unit property, one vacancy, one tenant leaving you is not a problem at all.
Yeah, absolutely. And I think the other thing that just, people don't put into the equation, right, when you're kind of going through that assessment, whether it makes sense for you to do a single family or not, is it's really opportunity cost, right? And your time truly is your biggest asset. So if you get stuck, dealing with tenants, termites, and toilets, it really just kind of sucks you into that. And like you said, I mean, it can be a great place to start if you're trying to build equity, or you're trying to, create a business as kind of a side hustle to kind of get something going. But as you really get bigger and you're trying to scale, it's really diminishing returns. So, okay, Rob, tell us a little bit more about the underwriting side. I mean, how did you how did you get so intertwined into underwriting? Did you study that in school, or where did this affinity for underwriting kind of come from?
So I studied computer science in school and always was a numbers guy, had a, kind of a numbers background. So when I started in the multifamily business, to me, I was naturally attracted to the numbers and naturally wanted to wrap my arms around the underwriting to really understand the business. I felt that that was kind of the critical component to understand in order to be able to actually be confident and have the ability to invest, right? You can't invest into something you don't know. And to me, I felt that that was the best way to know the investment, not so much, getting to know the kitchens and the actual infrastructure and all that kind of stuff. I gravitated towards the numbers. So that's where I began. And one of the best things that I did was actually build my own model, because that really enhances your learning, because now you're not just learning how to plug numbers in and get numbers to come out. You're actually seeing how the sausage is made, right? You're seeing every number and every formula, how they flow together, and you can see the impact of different assumptions, such as your pro forma rents, or your exit cap rate, your rent growth assumptions, and every single way that it's built together.
Yeah. So for folks that aren't really familiar with the underwriting process, for a multifamily deal, can you just kind of walk us through, what the process looks like, how you're building out your model?
Sure. So at this point, as I mentioned, I built a model from scratch, which was very educational and helpful. But now it wasn't just an educational exercise. It's the model that we use every day to underwrite, hundreds of deals. And of course, it's been improved on over time. And as we've adjusted our ideas, methodologies, strategies, we've adjusted the model as well. So essentially, when we look at a new deal, it's kind of an information gathering initial phase of, okay, well, let's make sure we have all the right information from the seller, such as the rent roll, the P&L, any other ancillary due diligence that we may need, and start plugging all that into the model. And then from there, that gives us the state of affairs of the property in its current condition. But what we want to do is identify the future opportunity of the property. So we need to look at the market data. We need to look at comparable properties on a rent and sales basis, so that we can create the most accurate picture of the future for the property, because that's how you make real money, is not by buying something as it is, but having a vision for a property and actually being able to execute on that vision. So that's kind of a very simplified underwriting process.
Yeah, no, I think that's really helpful. And then talk to us about assumptions, right? I mean, how do you really gauge, certain assumptions, like, rents, market rents, for instance, and what is a good projection rate, to build into a model? Because there's got to be some really reverse engineering from where do you want to get with a target profile for investors, and make sure that the deal is even good enough, right, to get through.
Yeah. And my favorite kind of phrase or way to think about it is defensible underwriting. You want to be able to defend every assumption. So if someone points at a certain assumption, like you said, rent growth, for example, you want to be able to defend that with some data, right? And that wouldn't be that hard to find. You would just go to CoStar, Yardi, or whatever data service provider that you use, and you would look at the rent growth projections for that submarket, for that property, neighborhood, whatever, kind of area that you're looking at. And that would be one way to defend that assumption. However, to your point of kind of making sure it's a good deal, you don't want to get carried away with something like that, because you could be relying too much on the market. At the end of the day, in my opinion, at least, you don't want to rely too much on the market to deliver your returns, because the market is not in your control. I would rather invest more so into uh, business plans or opportunities where we have more control over the outcome. So even if we're investing in a hot market, like it has been, where rent growth has been double digits, we're not going to put that in our model, and that's okay, because that's upside that's not factored into our underwriting, which makes us feel good about potential better upside. You don't want to necessarily bake every single piece of upside into the deal, because that means all you have really is downside.
Yeah, well said. And I think that's really the difference. I mean, again, a lot of investors who are kind of new getting into multifamily, they're just kind of thinking about it in terms of appreciation, right? Which they're used to on the single family residence, right? But in this case, what you just talked about is forced appreciation. So it's very different because you are taking, yeah, that vision and really trying to execute against that business model. Tell us also really about additional opportunities. I mean, one of the things I really love about real estate as well, even though it's, it's very stable asset class and everything, but there's just so much creativity to it, where you can identify additional revenue opportunities, things like, implementing a trash service, implementing, the group, cable service where you go direct to, Verizon and negotiate a better deal for tenants, right? Or putting in a pet park and then charging pet fees and things like that. Tell us how you kind of evaluate those types of, creative opportunities to, drive up the rents as well.
Yeah, you pointed out some good ones. Those are good examples, and there's so many more, as you know. And some of them are more established, some of them are more speculative. So we don't want to go out there and do a bunch of things that are speculative. We know the things that work as far as interior renovations, and you can look at comps as a way to prove out your plan. You could say, well, the deal down the street did these renovations and they're getting these higher rents. So it's very straightforward, and we can comp to that. Things that are a bit more just ambiguous or difficult to comp would be adding the dog park, like you said, because that may not directly enhance your revenue, because it's not directly adding revenue, but maybe it encourages more people to have pets, and then you have more pet fees coming in and things like that. Or you're just making your property more competitive on from an amenity standpoint compared to the other properties in the area, which just helps with leasing, renewals, right? That just helps your overall P&L. So basically, when it comes to things that are kind of more creative and speculative, we want to test them out first and see how well they are received by the tenants, and then before deciding to roll it out programmatically.
Right, right. Yeah, I think there's, lots of different opportunities there, but that was really key how you pointed out, really not looking at things that could be speculative, right? And this is kind of why we like this asset class so much, right? Because it's very stable and you can prove things out. So, and then would you, I guess what you're validating, which is pretty interesting point as well, that, people always love to say, like, again, I think, a lot of people can relate to multifamily, right? Because, they're living in their own single family residence. They've kind of gone through some transactions in their lifetime, right? And it's helpful. But people think like, hey, if we upgrade the kitchen, right, we're definitely going to get our money back, things like that. So that's pretty good. So you can actually evaluate and say, like, look, if we put in new flooring, fresh paint, and then we're going to upgrade, the appliances to this level in the kitchen, we should be able to, comp that and see what other, properties in the area have been able to achieve with those types of renovations.
Yeah, exactly. Yeah, it really isn't rocket science, and keeping it simple is definitely one of the benefits of the business. We don't have to. It's not. We don't have to reinvent the business plan every single deal, right? You can, for the most part. Every deal is different, of course, but you can, for the most part, identify an opportunity, and it'll be very similar to the last one, and you can rinse and repeat.
Yeah. And I know you're in a lot of, tell us about the markets that you focus on. I know Texas is a big one, obviously with Lone Star, right? Tell us the primary markets that you're focused on, Rob.
Houston and Dallas.
Houston, Dallas. Okay. And tell me, do you do anything in terms of underwriting for a particular market? So, we talk a lot about, job and population growth and things like that. We're trying to target those areas that have growth, but is there any representation of that in the underwriting model, or how would you really assess that?
Yeah, there is. And you'll see it two ways, I would say, and pretty much just as far as rent growth goes, right? And rent growth varies by market, varies by submarket within that market. So, you're going to change your rent growth, or you can change your rent growth based on submarket or market anyway. But the more interesting difference that I would point out is as far as return expectations. So some markets are just more competitive, and or they're perceived to be less risky. And if there's less perceived risk, then the potential return is lower as well. All right. If you're going to go invest in a very tiny market that has no growth and is there's one employer, it's a super risky market to invest in. You should have a very high projected return in your underwriting to justify buying in that area, or else it just wouldn't make any sense. But conversely, if you're buying in a top tier market like Dallas, for example, that everybody loves, everybody wants to be there, corporate relocations, population growth, job growth, everyone thinks it's super stable, diverse, it's going to continue to grow. Because of all those factors, we have to underwrite to a lower return expectation. So just to put some numbers to it, for example, maybe if you have two deals that are identical, but one's in a good location in Dallas and one's in a good location in Houston, you might demand or expect a 13% IRR on your underwriting in that for Dallas, but then that same exact deal in Houston, maybe it's a 15% return or 14, right? I'm not sure exactly. It's hard to quantify these things, of course, but there definitely is a difference there because you are essentially trading away projected return for being in that desirable market.
Yeah. Yeah. Good point. I also like to think of it in terms of just, just further insulation that you have in a deal being in some of those strong markets. Some people always ask, hey, why don't you invest in, Boston or, or New Jersey or something, right? I mean, and they just don't have the same metrics, right, in demographics that we're really looking for in terms of multifamily. Now, there's plenty of developers doing deals and things like that, but I think the risk profile is really much higher in some of those markets. So how about from an investor's point of view, if they're looking at a deal, are there particular things that you would recommend in terms of, advising them? What are some key questions you might want to ask around the underwriting of a particular opportunity?
Sure. Yeah. First, I would, if a passive investor is so inclined, I would ask the sponsor to see the underwriting. And even if you're not at that level or have the time available to really dig into it, just starting to look at more models and getting familiar with them. Also, you can judge the sophistication and rigor of a sponsor by their model. It doesn't mean that the most complicated looking model wins, but if it's organized, if it makes sense, that could be an indication that they're organized and that their stuff makes sense. Also, I don't know how prevalent this is, but there are some sponsors out there that are reticent to share their model for whatever reason, and I don't think that's a very valid thing to do or to be worried about as a sponsor. So if a passive investor encounters that, I would be a bit leery. Beyond just asking for it and taking a look, I would just kind of look at the highlights, which would be the pro forma rents relative to the in-place rents, and just looking at what kind of jump are we expecting, and then looking at the business plan relative to that rent increase and saying, well, does this feel justified? Does this make sense? Maybe take a peek at some rent comps just to look. That all should be prepared and put together pretty in a pretty digestible format by the sponsor through their model and their investment presentation. So it's not a ton of digging around for data. And then the other thing to look at is, right, you've got the rent increase, then you've got the growth over time as well. Rent growth typically you're seeing around 3%. I think that's reasonable to put in the model. Obviously, some markets are in double digit territory. Some markets are a bit lower. We're not necessarily trying to be 100% accurate when we're modeling this out. We want to be justified. We want to be conservative. And if your market for the last couple of years has been growing at 5-10%, putting 3% in your model is safe, in my opinion. And then lastly, you want to look at the exit cap rate, which for those that aren't familiar, the way that these models work to derive the sale price in the future, when you sell 3, 5, 10 years down the road, you do so by taking that year of sales income, the NOI, and dividing it by the exit cap rate. And you want to look at that exit cap rate, and it should make sense to you relative to the market cap rate where it is today. So if market cap rates today are around 3.5%, the exit cap rate should maybe be 4.5% or 5%, whatever that is, as you look at more deals and get more comfortable with those numbers. And obviously there's just more and more that you could dig into. You could look at the expenses and kind of look, okay, what's the seller currently paying for payroll? What are we projecting for payroll? And then you can go down the list of expenses and make those comparisons. But at the end of the day, passive investors aren't in this to become active investors and pour over financials, right? So I think building up a baseline level of understanding and then a strong trust in the sponsors that you're working with is the best way to go as an LP.
Yeah, no, good point.
What if everything you thought you knew about investing was wrong? Would you like to create a wealth strategy like the top 1% have and get exclusive access to top private equity deals that provide downside protection, tax efficiency, predictable cash flow, and have a lucrative upside? Discover how with the Pantheon Advantage and join our investor club today at pantheoninvest.com.
What would you say would be the biggest gotcha that you've seen in an underwriting model?
Biggest gotcha would be having to do with the business plan implementation or the stabilization period. So, sometimes you'll see models where the business plan just happens way too quickly. You go from the in-place rents and then you go to $100 or $200 higher rents seemingly overnight. And that's just obviously not possible. So you want to err on the side of being conservative when it comes to implementing the business plan and how long it's going to take.
Yeah. And what do you think today in terms of today's marketplace? We're in an environment right now, interest rates are rising, cap rates keep getting compressed. Is it becoming more and more difficult for you to find, good deals? What are you really seeing in the market and how are you managing that?
Yeah, it's always hard to find good deals, right? But right now, what we're experiencing with the upward pressure of interest rates and not a major adjustment in cap rates. Cap rates definitely, I think, are due to go up, and I think they already are. So it'll be interesting to see where the data comes in as we track it. We track all the deals that we look at. We track them as far as their going in cap rate, their yield on cost, the underwritten IRR, what the guidance pricing is versus our price, and we have all that data that we keep track. And then we do a quarterly webinar where we kind of analyze that data. So I'm really looking forward to the next one because it's going to be, I think, pretty big shifts in the data, because for the last 3 quarters that we've been doing these webinars and evaluating the deals, cap rates have just been slightly compressing every quarter. Everything's kind of just moving slowly in one direction. And I think this next round of data is going to show finally a reverse of that trend, and cap rates are going to show as being a bit higher. And I'm not sure what other insights will be in the data, but it'll be really interesting to see. So I think going back to your point of it's hard to do deals, interest rates have moved more than the cap rate move. So cap rates haven't moved to offset interest rates. So I think it's still squeezed. But what we're doing is we're now buying deals at much lower leverage. We were doing deals at 80% leverage, essentially the before the interest rate world, before the world freaked out. And now we're doing deals at 65, 70% leverage, which really changes the risk profile of the deal and really helps us get the best loan terms possible. The only downside is as sponsors, we have to go out and raise a lot more equity.
Interesting. And are you seeing that with, some of your peers as well as one way to, really underwrite a deal and structure a deal?
Yeah, I haven't seen a lot of, I haven't seen it a lot. I'm sure a lot of people are doing it, but I think a lot of people that are doing it now were the players that were doing lower leverage before anyway, as just kind of their general practice. And we're finding our willingness and ability to go down in leverage is allowing us to be more competitive in today's market, actually, because a lot of those players that were doing max leverage deals and kind of getting away with it because the debt was really cheap and the deals were working out. Yeah. They're finding it very difficult to transact in today's environment. And they might be, I'm hearing of groups taking pauses at the moment.
Interesting. Another point, Rob, maybe you could share. I know a lot of people don't realize this, but how many deals that actually come across your desk that, you don't even pencil, right, until you get to one that goes under contract. Can you give us just an idea of that ratio for you guys?
Yeah, it's about 100-1. It's about, so in 2021, we underwrote about 500 deals, I believe, and we did 4 transactions. So it's roughly shows you that it's about 100-1 ratio. We're trying to tighten up the ratio, trying to be more savvy with what we choose to spend our time on, right? If there's a few ways to look at how to do more deals. You can do more deals by increasing your funnel, and instead of underwriting 500 deals in a year, you could underwrite 1,000 or 2,000, right? Or another way to look at it is to increase your conversion rate through the funnel. So basically just finding better deals to underwrite in the first place, right? Just discarding the ones you don't want and then underwriting the ones you do. And we're trying to, rather than just increase the workload and underwrite more deals, which we're working towards doing by increasing our team and whatnot, but also can we work smarter, not harder?
Yeah. Great point. I think a lot of, investors, they might see different deals and everything, but they don't realize how much work has actually gone into a deal by the time they actually see it, can be underestimated. What would you say is the biggest insight you could share with listeners about writing your book?
Writing my book. So
from an underwriting perspective. Yeah.
Okay. From an underwriting perspective. Yeah. Well, I'm trying to think. I think a lot of people reach out to me after reading the book, and they really like the chapters about partnership structures, which is not the main topic, of course, because the main topic is actually underwriting and evaluating deals themselves. But I wanted to include those chapters about layering on the partnership structure. One, because it's important if you are going to underwrite a deal, you can't just underwrite it in a vacuum. You actually have to have some way to buy it, have some way to partner on it, right? And so you need your preferred returns and your promotes and how to actually plug all that in and make sense of it in your model to evaluate the deal. So I think that's a really cool insight where people sometimes gloss over the structure and they don't really dig into the details of preferred returns or how the promotes work or the fees and different things like that. So I think that's an eye opener for a lot of people who read my book.
Sure. And Rob, what would you say from a personal development perspective? What is the one practice that's yielded the biggest results for you?
I would say journaling and being just really explicit with my goals and writing down my goals almost on a daily basis, the way I look at it is just the more that I sit there, stare at my goals and think about how to achieve them, the more likely they are to come true. And also, it's really amazing how much time there is in the day. You know, a lot of people are always so busy and they have so much going on. And it's true, right? We're all very busy. But at the end of the day, if you look at your day and if you look at your goals in relation to your day, often you'd be shocked to think to realize, oh wow, I actually didn't spend any time moving myself closer to my goals, right? Not at least directly. So what I really like doing is looking at my goals and then looking at what I can do today or this week or this month to inch me or take a leap closer to reaching those goals.
Yeah, no, well said. It's really interesting because, you know, as we live in this digital age, and I came out of the tech space myself. So I mean, I just remember, I mean, I put everything was digital, you know, the apps on your phone, you know, wherever you go. And I don't know, maybe 5, 6 years ago, I learned the power of journaling and writing things down. And I can't believe how powerful it really is to just sit with pen and paper and get your thoughts down, and how much clarity you get. Because once you get clarity, right, that drives confidence in what you're doing, you know, and then that creates a new capability. So it's super powerful. And I totally agree on the goal side as well. You know, when you stretch out and you say, hey, here's a 1 year goal, here's a 3 year goal, here's a 10 year goal, it really simplifies and cuts through all the noise. You know, you say, well, in 10 years, you know, I need these three things, you know, I'd be really satisfied. And then you're right. Once you can define it, then you picture it in your mind and you're thinking about it all the time. So if you're not doing activities or creating habits that support those goals, you're actually, you know, not getting any closer to them. But having them crystallized in your head as to what they are, writing them down, you know, you're in a much better position to achieve them.
Yeah, and you're always going to find time to do what you need to do to keep things going. And what I mean by that is if you're running a business, you're going to find time to get your mission critical stuff done to keep the business running. But there is absolutely no guarantee that you're going to find time to do something, for example, like writing a book. That's the easiest thing to procrastinate. And it's something that I've procrastinated my next book for a year. You know, I started writing it and then pretty much for a year, I just put it down and didn't touch it. But I still found time to, you know, buy deals and manage my team and raise capital and do all that sort of stuff. So the way I look at it is you don't really need to budget for getting your regular day-to-day stuff done. You will find a way, but budgeting time and you know, writing in your, you know, daily journal or whatever you need to do, you know, to take time out, you know, whether it's an hour or 2 hours, however long, to actually do big, you know, deep work type stuff, such as writing a book, that's really critical.
So Rob, where do you see yourself in 5 years?
I think the goal for the next 5 years is really just to build on the foundation that Lone Star has built. Lone Star was started by myself and my business partner Kent over 4 years ago now, and you know, we're just getting started, we're just getting established, and it's turning into a real business. So now it's going to be a really fun next 5 years of kind of, I don't want to say institutionalizing the business, but really turning it from a startup into a well-oiled machine where we build the team, we build the processes, things can just hum. And with that, you know, well-oiled machine, I would like us to be, I'm not sure what the number is, but you know, multiple billions in assets under management and really have a real deal portfolio.
Yeah, awesome. Awesome. I know you have a conference coming up in September, Rob. Do you want to tell the audience about that?
Yeah, sure. The conference, it's going to be our second time putting on an event here in New York. I'm bringing together, you know, pretty much the best of my network together, really with a focus on capital, which means family offices, private equity firms, crowdfunding platforms, you know, debt and equity funds. So I love bringing those people together. And then there's going to be obviously great sponsors in the room as well. And through that connection, we do a deal Shark Tank where I put the family offices and the private equity firms as sharks, and then I have sponsors pitch deals, and it's always really educational to not only watch the pitches and learn more about a good pitch, but also really learn how the sharks or the investors react to the pitches, what follow-up questions they ask. And that's a really good way to kind of sharpen your skills and understanding of deals. And if you are a sponsor looking to improve how you present your deals, then I think that's a really great way to go as well. So that's a highlight. I really enjoy that, and everybody likes that. So we're bringing that back this year. And and otherwise, it's just a great opportunity to network and hopefully walk away with some contacts to do more deals.
Awesome. And what's the URL for folks?
The best way to find it is on our website. Our website is lscre.com. And then we have an events page on our website, which will take you to the upcoming event in September.
Okay, excellent. Well, and we'll link that in the show notes as well. Any other, links, or if people want to reach out to you or follow you, what's the best place they could do that?
Yeah. So on the same website, on our website, lscre.com, I have a giveaway, free download of our underwriting model that we use, and I keep that up to date. So that's our latest and greatest model. So if you are interested in downloading an underwriting model to start looking at deals with, you're more than welcome to download ours. And then we have other articles and video resources and whatnot on our website. And you can obviously subscribe to our monthly newsletter, which I write an article. That's something I don't procrastinate, which is I write an article every month for the newsletter. And that's been consistent for I think over 3 years now. And then finally, on LinkedIn, I post every single day, and I'm active on LinkedIn. So if you want to connect with me, you can connect with me on LinkedIn or shoot me a message there.
Yeah, that's awesome, Rob. And I personally, I've really enjoyed your content, and I love how you get into the weeds. I even went through some of the training stuff that was really well put together in terms of underwriting. So thanks for putting that together, and hopefully folks will reach out because you've got some really, really solid content.
Yeah, thank you a lot. Yeah.
Awesome. Rob, thanks so much for coming on the show today.
Yeah, thanks again for having me. It was a great conversation.